Okay, in Chapter 4 we're going to look at cost, volume, profit analysis. You may also remember this in your past courses as break-even analysis. I believe break-even or cost, volume, profit is one of the most useful things that you learn throughout your accounting and finance courses. Comes in handy in a whole bunch of different circumstances. You have already seen this in financial accounting and finance, so this is going to be another review. So we'll go back through it in a little more detail, but also we're going to move kind of quickly through it because this should kind of be in your memory. Alright, so when we talk about CVP, we look at the impact of cost, volume, and price. Okay, how do those three things affect whether our company makes money or how much money they make? So we look at CVP analysis when we're starting a company. We look at it when we're making changes to a company, debating a new product line, new process, new service, anything like that. Alright, so break even. Definition of break even is where we don't make money, right? So where our total profits and our total revenues equal our total costs, so zero profit. Okay, that's not necessarily our goal, but it's a really important benchmark, especially if we're a new business losing money at the beginning, then break even is an exciting time for us. But it's important to know break even if we're not a new business, so that we understand where that level is, how close we are to it, how changes in our price or our volume or our costs impact that break even. Really important to understand the implication of our actions. So some of the things that CVP does, it helps us understand those number of units we have to sell, helps us understand what happens when we reduce fixed costs or increase variable costs, what happens when we can change our price. So basically a lot of the strategic decisions we make in a company, how those are going to impact our profitability. So if we look at some of the things that the definitions we need in our cost, volume, profit analysis, our variable costs includes our direct material, our direct labor, and our variable selling and administrative costs. Our fixed costs are things like fixed overhead and fixed selling and administrative costs. So remember again from last chapter, variable costs are those things that change with output. Fixed costs are those things that don't change with output. So a fixed cost is something that stays the same regardless of how many we make. The actual fixed cost may change over time. So in other words, our rent is a fixed cost. It doesn't change with the number of products we make, but it could go up over time. Alright, so how do we use cost, volume, profit? How does that translate into what we've been looking at with our income statement? So contribution margin, if you recall, is the difference between our sales and our variable expenses. So sales minus variable expenses. And remember that we use the word sales and revenue interchangeably here. So we could easily say we could say revenue minus variable expenses. So when we have contribution margin, it means our price that we charge for our product covers the variable cost of the product, and whatever's left over will contribute towards the fixed costs and the profitability of the business. So how does a contribution margin income statement look like? So this is an income statement that we use for internal purposes, not a GAAP approved income statement, but it looks very similar, right? So here we have the company, the Whittier Mower Company. They're planning to sell 1,000 mowers, $400 each, and you can see the costs associated. So let's put that into a contribution margin income statement. Okay, so first thing we do is come up with the variable expenses. So our variable expenses are anything that changes with the number of mowers we make. So in this case we have direct materials, direct labor, variable factory overhead, and variable selling. Notice it doesn't matter that selling isn't a product expense. It's anything that's variable. So that's $325. Our fixed expense would be the fixed factory overhead and the fixed selling and administrative of $45. So we put that together. We have our sales minus our variable expenses gives us a contribution margin of $75,000. That goes towards the fixed expenses of $45, and then whatever's left over is our operating income of $30,000. Okay, so that units or that break-even income statement, our contribution margin income statement, can help us to pull the numbers that we need for our break-even analysis. So down here at the bottom is some of our CVP equations that are very helpful. So operating income, we know this from our income statement, is sales minus total variable expenses minus fixed expenses. That's what we just did. So remember that how we built that, our operating income was price times the unit sold. Our variable expenses was variable cost times the unit sold, and then our fixed cost. So what we're doing is building to a nice break-even formula. So for Whittier here, let's look at how many units they need to sell in order to break even. So how many mowers, okay? So when we look at this formula, and this is kind of the one I want you to write down for your notes and keep using. This is our basic break-even formula. So it takes that formula and kind of reduces it to a simpler format. So we take our total fixed cost, we divide by the price per unit minus the variable cost per unit. Okay, that's our break-even number of mowers. So we take the $45,000 in fixed cost divided by the $400 price minus the $325 variable price, again per unit in the denominator, total in the numerator, and we get 600. That means by definition if we sell 600 mowers we make nothing. So now we prove that by putting 600 back into our income statement. And you'll see we take 600 times our cost, we take the 600 times our 600 times our price, 600 times our variable cost, give us a contribution margin of 45, our fixed expenses are 45, and boom, our operating income is 0. So the nice thing about your break-even is you can always check your work and make sure that you did it right. So our break-even point in units is very, very useful. That's our basic CVP equation I just had you take note of in the last one. I think that's easier than doing it here, horizontally across, I think, is using the one that we just did. And this is it again if you want to print out this slide. Total fixed cost over price minus variable cost per unit. Now sometimes break-even in units is less meaningful than break-even in dollars. Okay, so we can get break-even in dollars by simply taking the selling price times the number of units sold, right? If I said I need to sell 600 mowers to break even, well, 600 times $400 price per mower means I need to sell 240,000. So that's pretty simple. But sometimes calculating the break-even point in dollars isn't as simple. Okay, sometimes we want to just go directly to the sales dollars. And let me give you an example before we get into the calculations. Let's say that I own a jewelry store and I want to know what my break-even is, how much to pay for the nice rent in the mall. How many necklaces and rings do I have to sell in order to cover all those expenses? Well, the problem with a jewelry store, right, I could have a ring there that's $100 and I could have a ring there that's $100,000. So to come up with an answer that says I have to sell 3 rings isn't real meaningful for my jewelry store. But if I come up with an answer that says I have to sell $200,000 worth of jewelry per day, that's more useful because I know either I sell 2 really expensive things or I got to hustle 20 less expensive things. So that's where coming up with our break-even in dollars can be really useful for a company. So how we do that is by converting our contribution margin into a ratio. Okay, and that's pretty straightforward. You'll see here I take my contribution margin divided by my sales per unit or my price, and I get a 40%. So here's $4 divided by 10, 40% price, or 40 divided by 100 is 40%. Same exact thing, right? So once I have my contribution margin ratio, I can convert that and turn it into a break-even per dollars. Now over on this side we showed you a variable cost ratio. It's the same thing. Remember, by putting it in a ratio I'm just converting a number into a percent. So in this case I take my variable cost per unit of $6 divided by my my price of 10, and I get a 60% variable cost ratio. So the key thing to remember here is my variable cost ratio and my contribution margin ratio always have to add up to 100%. Because I'm just coming up with what's left out of the sales price. So sales is my denominator, my price on both of these, $10. And over here is my variable cost, and over here is my contribution margin. So by definition, my price minus my variable cost equals my contribution margin. So you'll see that you have to add up to 100%. All right, so let's calculate those for our mower company. All right, variable cost per unit was $325. Our price was $400. That gives us 81.25% variable cost. By definition, that means our contribution margin has to be 100% minus that, which it is at 18.75%. But I can calculate that down, 75 over 400, and get that. So again, here I can check my answers and make sure those add up to 100%. So if I plug that into my contribution margin statement, you'll see 400,000, 325 in variable expenses, contribution margin of 75, fixed expenses, and there's my 30,000. So again, those two have to add up together. So the contribution margin is the revenue remaining after variable costs are covered. Okay. So if fixed costs equals contribution margin, the company is breaking even. If fixed costs are less than the contribution margin, the company is making a profit. If fixed costs are greater than the contribution margin, the company is making a loss. Okay, that's pretty straightforward. So now let's look at, again, that instead of coming up with how much I need to break even, maybe I want to come up with how much I need to make a certain amount of money. So maybe I'm starting a business and I want to know how much till I make $50,000 so I can quit my day job or something like that. So what we do with dollars to achieve a target income, we use that exact same formula as the break-even formula, you'll notice. But on top, we just add that target income. So we just pretend that's another fixed cost that we want to make. So we take the old formula, remember, was fixed cost divided by price minus variable cost. Now we just take fixed costs and add target income and divide by price minus variable cost. So pretty straightforward and pretty simple. When I calculate my break-even in dollars, instead, I take my break-even sales dollars, I take my fixed expenses, and I divide it by my contribution margin ratio. So remember a couple slides ago we just showed you how to calculate the contribution margin ratio. Well, now if I divide my fixed expenses, dollars, by a percentage, contribution margin ratio, my answer is going to be in dollars. So I'm going to get my sales dollars. So that jewelry store can figure out how many total dollars in sales it needs to make to break even. So this is another good formula to make sure you've written down. Very simple, but handy. All right, so let's take a look at that. Again, for our mower company, we want to sell, again, the prices have stayed exactly the same, so let's just go through the calculations. Contribution margin was $75. Contribution margin ratio was 18.75. It was the same exact one we just calculated a couple slides ago. A nice hint down here, though, says don't round too much. Okay, when you round those percentages, your answer, your final answer, will be very skewed. So you want to keep that carried out quite a few decimal places. Because if you rounded this over to 19 or to 20 really quick, your answer, your final answer in terms of dollars, will be very different than what it really is. So keep it carried out, 4 places at least. That's fine. Okay, so when we do that to calculate the break-even sales dollars, I take those same fixed costs of $45,000. Now I just divide by that contribution margin ratio. And remember, it is this is wrong. It was 0.1875. This is just a typo on the slide. Sorry, it wasn't 81.75. This should be 0.1875 from the earlier slide. But the answer is $240,000. So what we can do again is test this. We can put in the sales, okay? So what they're showing you here is the variable expense ratio. They have that screwed up here. But anyway, some problems with numbers on this particular slide. But we have $240,000 in sales. Then we can figure out the variable expenses. You'll see that our contribution margin is 45, and our 45,000 fixed expenses would give us a $0 operating income. So we can put in, just like we did to prove our break-even in units, we can prove our break-even in dollars by making sure our operating income comes out as 0. So keep that in mind for the test. You can always check the answers that you're given and put them back in the formula and see if you pick the right answer. Okay, so how about if I don't want to make 0, I want to make some money? How do I calculate that? Okay, so again, the Whittier company, now we want to make $37.5. So what do? Well, now all I do is take that same break-even formula, add what I want to make, that target income, on top to my fixed cost, divide by the same price minus variable cost, and now I get that I have to sell 1,100, which makes sense. If I need to cover more, I need to sell more units. We would expect that to be higher than our earlier break-even answer. So again, we got to use some common sense here. Plug that back into our income statement and prove that yes, in fact, if we sell 1,100 mowers, we'll make $37,500. Again, I can always check my work. Okay, so again, if I want to do that with dollars, same exact thing. I just take the target income and add it to the fixed cost, divide by that contribution margin ratio, and I can calculate my target dollar sales revenue. So what's nice is I can do units or dollars. The formula, there's just 2 basic formulas, and on top I just add in that target income if I want to do that. Okay, so again, how does Whittier, how does that look? Same thing, except here, thankfully, we have the correct contribution margin ratio. You'll see I take the target income of $37.5 and the fixed cost of $45, divided by the contribution margin. Now I have to sell $440,000 worth of mowers if I want to make $37,500. Again, I can prove that out through my income statement. So what's nice about contribution margin is it allows us to kind of understand what happens if things change in our company. So the profits are going to change in this formula, contribution margin ratio times change in sales. So how much I have for contribution is directly impacted by the change in my sales. So in other words, as my sales go up, my revenue is going to go, my profit is going to go up by my contribution margin ratio. Okay, so that's pretty simply just shows you how sales is going to benefit you, increase in sales, or conversely how a decrease in sales will hurt you. All right, so some of the problems with CVP or some of the assumptions we have to understand. They assume that the cost and function, the cost formulas that we're using stay the same over time. So in other words, our variable cost is pretty consistent, our price is pretty consistent. Assumes that we can figure all that out, that we know that the goods are sold, that the sales mix is sold. So some basic assumptions. And some people will tell you those assumptions create problems, but I would tell you that the benefits of using CVP and understanding it far outweigh any limitations, because you can really use CVP analysis to understand a lot of decisions that are made in companies and why. So let's take it for example and say your company is faced with a cost increase from your supplier. Well, if you don't do anything else, if you plug that into the CVP formula, the increase in cost on the denominator, if you don't do anything different, you have to sell more units in order to make the same amount of money that you make now. So you either have to find a way to lower other costs, to increase your price, or do whatever it is, whatever you think you can do to make the company more efficient. So CVP is really good strategically for understanding the impact of all those decisions and how they interconnect. So CVP again helps you to understand all that risk and uncertainty. Obviously have to be it. So how do we deal with this? Okay, sometimes what we can do with CVP analysis, and I would certainly recommend it, is do what we call sensitivity analysis. So sensitivity analysis, we could say, okay, what is the break even if we can't get that price? What if we're off by 10%? What's the break even if we get a 15% increase from our suppliers? What's the break even if our fixed costs go up by 10 grand? We can do kind of all these what if scenarios to help understand how break even is impacted and how robust our business is. If it's real sensitive to a few minor changes, we should be concerned. But if over quite a big variety of possible scenarios, our numbers still look attractive, still look like things we can handle, then we're probably feeling pretty comfortable about our business model. All right, what we are going to talk about towards the end of the chapter here is something called operating leverage and the margin of safety. Okay, what we have here is just a picture showing you the units sold versus the units break even. So what we're trying to do is compare those. So let's start with margin of safety. Margin of safety is a pretty simple concept. It just says, what buffer do I have? So if I say my break even is 200 units and I currently sell 500, then I have a buffer or a margin of safety of 300 units. So I feel pretty comfortable that even if my sales dip a little bit, if I'm down 10%, I'm still going to be in the black. I'm still going to be okay. So the margin of safety just lets me know how comfortable I am where my current sales are compared to break even. If I'm getting close, I'm probably getting very concerned, and I think I have to do something different, either attack my fixed cost, change my price, figure out something with my variable costs. So here we'll show you we can do margin of safety in dollars, so revenue minus break-even dollars, and I can get it as a $300,000 number. I can also do it as a percent, margin of safety divided by revenues, and say it's 60%. So lots of different ways I can talk about margin of safety. So we can compute that for Whittier, and we'll see if we plan to sell 1,000 and we currently, in the previous slide said our break-even was 600, you'll see we have a margin of safety of 400. In sales revenue, that's the difference of $160,000. Okay, and then the last concept we're going to talk about is operating leverage. Okay, kind of a lot of big terms here, but operating leverage, if you think of leverage like you would use it in your everyday conversation, leverage refers to getting an advantage, right? If you say I have more leverage than you in this negotiation, somehow you have more power or advantage. Well, we're talking kind of about the same thing with our operating leverage, but in this case we're using fixed costs to get more money, to get a higher profitability for our company. So operating leverage refers to the proportion of fixed costs in the company's cost structure. So basically it's telling you how many of my costs don't change with volume and therefore I'm stuck with whether volume goes up or down. So just to put this as a visual in your mind, I think the ultimate fixed cost operation is an airline. Okay, so picture yourself on your Southwest flight down to Florida for the summer, and you head down south on the plane, and if there's 75 people on your flight or 100 people on your flight, how much of the cost change? Probably not much, maybe a little bit of gas by weight or something like that, maybe a little bit of fuel. But the attendants still have to be paid, the pilot still has to be paid, the gate fee still has to be paid, the maintenance still has to be done. So all the costs associated with that flight are essentially fixed. Maybe the cost of the peanut and the Coke they give you would be the only variable cost. So when you have something that has high fixed costs like that, we say it is a high degree of operating leverage. So that means it's very volume dependent. So when times are good and that plane is full, they're making a lot of money. But when that plane is not full, they're not necessarily making a lot of money, could even be losing money. So when we have a high fixed cost operation, their profit potential on the upside is better, but their loss potential on the downside is worse. Okay? So we can refer to that as the degree of operating leverage, and we can calculate that by taking the contribution margin and dividing it by the operating income. So that's giving you, again, an indicator of risk. How sensitive is this company to changes in volume because it's so fixed cost dependent? Okay, in this case for Whittier, we can calculate, we can put the degree of operating leverage by taking the contribution margin, dividing it by the operating income, and we get 2.5. So then we know that is a reference number for how leveraged or how risky that company is, and we can compare it to other companies in their industry. So just to give you an example of how leverage would play in, let's say you start your home business and you're making cupcakes out of your kitchen, okay, and you're selling your cupcakes. So, the business has very few fixed costs because it's all your personal home that you've already paid for. So if people like your cupcakes, you're going to make cupcakes and you're going to make some money. If people don't like your cupcakes and you stop, you're not going to make money, but you're not going to lose a whole bunch, right? Because you don't have a lot of fixed costs that you have to pay for the business. If you go out and rent a bakery's office and start making your cupcakes out of a storefront and people like them, you can make a whole lot more cupcakes than in your kitchen. So you can make a lot more money. But if people don't like them, you still have to pay the rent and you have to pay all the costs associated with having that facility, and you're going to lose a lot more money than if you were in your kitchen. So that's how leverage works. On the upside, it helps you make more money, but on the downside, it makes you lose more money. Okay, so I hope you understand the basics of cost value profit analysis. Really encourage you to spend some time with the homework on this chapter. I think it was very important. You definitely will see some of these on your first quiz.